Pabari, founder and managing director of CR Forex. Last week we got calls from a lot of exporters. They were asking one single question. The dollar index has moved from 93 to 96 level, but why our Indian rupee is trading almost at a flat level? So in today's presentation, in the first part, we will answer that question, and in the second part of the presentation, we will discuss what is the outlook for dollar rupee pair for the coming days. So there are three reasons why Indian rupee was trading on a flat basis. Dollar index from 9th November till 19th November, it has gained 2.5%. If we see dollar index ka composition, 70% of the weight comes from euro. Euro has fallen down by 2.5%, which has underperformed against other DM currencies, developed market currencies. One of the main reason why euro has underperformed is that in Germany, we have national emergency. They have declared a national emergency because of rising COVID cases. And Germany is one of the most important state in the entire Eurozone. If it underperforms, then definitely euro will see under pressure. Now, let us see what has happened in the emerging market space. Despite dollar index rising by 2.5%, if you see, other emerging market currencies have not depreciated that much because there is no such panic button created in the emerging market space. Emerging market average depreciation has been 0.5%. Indian currency also depreciated close to 0.57%. Second reason for the stability is that we have seen continuous IPO money coming in Indian equity market, because of which the dollar rupee pair was stable. Third reason, in last 10 days, crude oil price has come down by 10%, close to 10%. Because of all of these three reasons, we have not seen dollar rupee pair moving towards 75 and 75.5 level. This is all history. Now let us move to the second part of the presentation, that what will be the outlook for dollar rupee pair for the coming weeks. Overall, for the next week, we are expecting the dollar rupee pair to trade between 74.20 on the lower side and on the higher side 74.75. Once 74.75 is broken, then the first target for the dollar rupee pair will be close to 75.25, and the final target is 75.5 level. Overall, we are expecting a weaker biasness for dollar rupee pair. There are three reasons for the same. Pehla, we are expecting Indian equity market to underperform in coming days, and we expect FIIs to continue to sell from Indian equity market. The second reason is we expect dollar index to move to a higher level of 96.5 to 97 levels in coming days. Third, rising trade deficit. From last 3 months, our trade deficit is coming close to 20 billion per month. If it continues to do that, it will have a negative impact on the pair. Now let us move to the final part of the presentation, that what is the ideal strategy for exporters and importers. For thin margin exporters like agri exporter or chemical exporters, they must have taken costing close to 74 to 74.20 levels. We are telling them they can wait with a stop loss of 74.20 or costing, whichever is higher, and they can target 74.55 to 74.60 levels. Thick margin exporters like pharma exporter or textile exporters, we will advise them not to sell at lower levels. If the money comes, then they can utilize the forward contract which they have booked at higher levels. For further booking, we advise them to wait till 74.70 or 74.80 levels. Overall, we request them to keep a hedge ratio below 50%. Ideal hedge ratio for them should be close to 40 to 45%. Now, what is the ideal strategy for importers? As the overall biasness of the pair is on the depreciating side, we will advise all our importer clients to hedge till December end. 74.20 से 74.30 का level मिलता है, then they should definitely cover till December end. With this, I will end my today's presentation. जय हिंद, नमस्कार, फिर मिलेंगे next week. Thank you.